Every era has a room where power concentrates. Once it was smoky coffeehouses where rumors move faster than ships, then marble trading floors packed with shouted orders and jangling phones. Today, the rooms are silent concrete warehouses at the edge of town, burning megawatts and evaporating water by the acre. No bells to ring, no crowds to cheer, just racks of machines deciding what gets built, what gets funded, what gets censored, and what gets left behind. The world says cloud because it sounds clean and far away. The world pays rent because someone owns the ground and the wires in the door. Look closer and you'll see the real action. Data centers are the new trading floor. If you want to know where tomorrow's fortunes are made, follow the fiber and the power lines. This is the place where money, power, and history collide, and nothing is ever as simple as it looks. Markets run on information. Information runs on computation. Computation runs on land, power, water, and physics. That's the chain. Break any link, and the modern economy hiccups. Snap it, and the whole illusion blinks. For 2 centuries, the trading floor was the theater of capitalism, the visible ritual that told the crowd where prices come from and who's in charge. But the stage has moved. The price discovery of the 21st century, the place where valuations, votes, and narratives are marked to market, now happens inside cooled rooms you're not invited to. This isn't just an engineering story. It's political economy in steel and concrete. It has winners, losers, and a bill that someone will pay. Start in London, 1690s. Merchants cram into coffeehouses to gossip about ships, wars, and weather. Information advantage is everything. If you know first, you trade first. Out of that chaos, the stock exchange is born, a physical room where proximity equals power. Skip ahead to the telegraph. Wires flatten distance, and being closest shifts from a bar stool to a telegraph office. Then the ticker tape, then telephone switchboards. Every leap is the same story. Buy a head start. In the 2000s, high-frequency traders paid to collocate their servers inside exchange buildings, shaving microseconds by placing their racks a few meters closer to the matching engine. It was a new version of an old instinct, the front row seat, the better chair at the poker table. The old floor was theater. The new one is a fridge with lasers. The lesson is simple and ruthless. Markets migrate toward the infrastructure that lets them move faster. And markets aren't just stocks anymore. Ads are auctions. Rides and rooms are auctions. Your attention, your loan, your search results, auctioned. Even truth, at least the version you see first, is cleared like an order book. Where does that clearing happen? The same place the modern economy keeps its breath? In data centers that feel like warehouses until you follow the money. Markets pretend to be abstract. Physics refuses to play along. Computation produces heat. Heat demands cooling. Cooling demands space and water. And the shortest path between 2 points is still a straight line through someone's farm, someone's neighborhood, someone's city council. Look at a fiber map and you find new Wall Streets, where power is cheap and dark, fiber is thick. Ring roads around major metros, corridors along railways and interstates, valleys with cold air and cooler politics. The old pits were downtown. The new ones sit on floodplains, brownfields, and the edges of airports, where megawatts are easier to buy than permits for people. In the 19th century, traders watched for the first puff of smoke on a railway line because smoke meant news. Today, companies quietly lease strands and buried conduits along the same corridors because the fastest route between 2 data halls is an underappreciated empire. Speed matters. But what really pays is determinism. Predictable latency becomes a financial product. If you can guarantee the variance of a round-trip packet, you can guarantee a spread. The invisible scaffolding of prices, ads, inferences, video streams, real-time bids, leans on those guarantees. When the timing is certain, the commerce is certain. You don't see it. Your portfolio does. Your feed does. Your odds of getting a loan do. On yesterday's trading floor, the prime broker lent you shares, financed your positions, and made sure your bets cleared. In the new regime, the utility is your prime broker. A data center is a bond with fans. You borrow billions in capex on the promise you can rent compute tomorrow. Your counterparties aren't pit traders. They're power companies, municipalities, and water districts. Your margin call is a heat wave. Your covenant is a substation. The language of finance slips in because it never left. Power purchase agreements, hedges for electricity, capacity reservations like options on the future. The operators that win aren't just good at building rooms, they're good at trading electrons. They arbitrage time of day rates, build on-site generation, ink long-dated contracts, and, quiet part out loud, shape public policy to make the math work. When demand surges, AI training cycles, a sports final streaming to half the planet, a new video platform, the market doesn't pull more traders into the pit. It pulls more megawatts through the transformer. Throughput has become a regulated asset. The company with guaranteed power at the right node owns a toll booth on the economy. If this sounds like the bond market, that's because it is. Steady cash flows, covenants, ratings, systemic importance. The grid is the clearinghouse. Miss a delivery and counterparties get nervous. Get nervous enough, and you discover the only collateral that ever mattered was confidence. On the old floor, a handful of market makers set the spread. In compute, a handful of cloud platforms set the egress. They rent you the rack, the network, the database, and then charge you to leave. The spread is baked into your architecture. Lock-in is just a polite way to say we price the door. Exchange is used to sell seats. Clouds sell regions. Move your workload from one region to another and you bind. Have you moved your listing from London to New York? Different latency, different rules, different liquidity of services. The decision sounds technical. It is mostly financial. What are you willing to pay for the right to change your mind? Behind those platforms sits a quieter cartel of leverage, chips. If you want to train the models that will decide credit risk, medical triage, logistics, or who sees what headline, you line up for accelerators the way funds once lined up for IPO allocations. Capacity isn't just a technology constraint, it's a price signal. The entity allocating scarce compute is allocating the next decade of returns. Democracy decides who governs, markets decide who survives. In this era, the market makers for survival are selling racks and instruction sets. Consider the new order flow. Traders once paid for a first look at someone else's intent. Today's operators pay for something cruder and more decisive: permits. A letter from a planning board that says, yes, you can pull 200 megawatts and 3 million gallons a day here is a golden ticket. It's not glamorous. It's not on a terminal. But it's price discovery of a very real kind. Where can the future physically exist? Every additional megawatt you reserve is a chip someone else can't use. An EV plant delayed, a hospital expansion scaled back, a neighborhood postponed. We don't deprice those externalities well because the bill doesn't OT arrive as a line item. It arrives as a summer brownout or a lake running low. So municipalities do what exchanges did a century ago: bid for liquidity, tax abatements for data halls, fast-tracked zoning, innovation districts that are industrial parks with better fonts. The platforms do what platforms do: promise jobs, sprinkle grants and warehouse optionality, land, permits, power rights, like a trader accumulating positions. The carrying cost is low, the upside is control. It looks like real estate. It behaves like a derivative on growth. If you think this is too dramatic, watch what happens when the room goes dark. Remember the old market flash crashes, a feedback loop, a missing circuit breaker, a fat finger, and prices vaporize for minutes that feel like hours. Now map that mentality onto a cloud region or a major content distribution node. It's not just a website down, it's payment rails, hospital systems, logistics queues, ad markets, and a dozen other just-in-time miracles suddenly not. When that happens, liquidity dries up. Traffic reroutes, costs spike, SLAs get invoked, and executives learn that redundancy was a slide, not a system. The old floor had a bell to end the day. The new floor has incident bridges and status pages. The reflex is the same: stall, patch, reassure, because confidence is the oxygen that keeps the fire from drawing too fast. Listen to the way we talk about these buildings, and you'll hear the old vocabulary wearing new clothes: tiers, uptime, disaster recovery, failover, replication. That's risk management. We've rebuilt the market's nerves. We just house them in buildings with badge readers and cooling towers. States have always understood the trading floor as a lever: close it during war, open it to sell bonds. In the 20th century, they learned capital controls, keep money from fleeing. In the 21st, they're learning compute controls, data localization laws, export restrictions on chips, sovereign clouds that look like compliance and feel like choke points. Flip a software switch, cite a policy, and reshape an industry's margin. Don't confuse the soft tone with soft power. The penalty for disobedience isn't a fine. It's losing access to the industrial machine that runs your product. And yes, there's the surveillance angle. The new trading floor clears not just equity orders, but attention, language, and behavior. Control the inference endpoint, and you don't just monetize queries. You moderate reality. That's not conspiracy, that's policy. Who wins? Operators with guaranteed power at strategic interconnects, platforms that internalize latency and externalize egress fees, chip suppliers that translate scarcity into pricing power, jurisdictions that trade permits for clusters and know when to say no. Who pays? Startups that turn variable bills into fixed dependency. Municipalities that discover tax breaks are permanent and jobs are not. Citizens whose water and grid headroom were the invisible subsidy. What survives? Assets with cash flows insulated from policy mood swings or aligned to them. Skills that convert watts into useful intelligence, efficiency, scheduling, model distillation, hardware-software co-design. Architectures that treat regions like counterparties, not decorations. Multi-home by default, rehearse your exits, price your risks. Strip the romance from the word cloud. These are power plants for intelligence. They look like real estate. They behave like banks. They are financed like infrastructure and regulated like nothing we've decided yet. The deeper lesson is uncomfortable because it's obvious once you say it. The old trading floor rewarded reflex. The new one rewards thermodynamics. Your alpha is not be early. It's be efficient. Compute that wastes heat and water is compute that loses money. Networks that jitter are spreads that evaporate. Facilities built on fantasies about infinite power and infinite patience invite a margin call from physics. So what do you do if you're building in this world? You treat headcount as a rounding error and watts as destiny. You carry your architectures like passports, not mortgages. You assume regions will fail and regulators will knock and costs will spike, and you design for the practice run, not the fantasy. You learn to price latency the way traders price risk. You learn that the most expensive button in your stack is egress, and you don't press it by accident. You get sophisticated about your contracts, PPAs, reservations, the fine print on burstable, because those terms are where the spreads live. If it sounds like finance, it is. If it sounds like survival, that's because the market doesn't care what you call it. Debt, we've said before, is designed to roll. These campuses roll too, capacity to capacity, generation to generation. You don't finish a region. You refinance it with newer chips, fatter feeders, colder cooling, shinier sustainability reports. The rent never goes away, it grows. And the wealth flows to those who own the bottlenecks, permits, interconnects, compilers, and the right to root. None of this is villainy, it's structure. But structures choose winners. When the marketing says serverless, remember, someone buys the server, someone signs the power contract, someone negotiates the water right. Abstracted just means you can't see who's getting paid. We love rituals. Wall Street rings a bell, traders clap, cameras flash. The signal says the market is open. Here's a quieter truth. The bell that matters now is the click of a relay at a substation 20 miles away. When it closes, the market opens. When it pops, the market gasps. Politicians will talk about innovation, jobs, AI leadership. They'll sell you the upside and offload the externalities. The question isn't whether we build the new trading floor we already did. The question is whether we price it honestly, in megawatts, in gallons, in latency, in lock-in, and in the attention of a society increasingly intermediated by machines. Maybe you still picture finance as a handful of brokers, shouting bids, red-faced and triumphant. It's a comforting picture because it makes power look noisy and fragile. The unsettling thing about the new regime is how quiet it is. Fans, not voices. Badges, not brokers. Algorithms matching not just orders, but predictions of your breakfast, your commute, your vote. The trading floor didn't disappear, it metastasized. It's humming right now, cooling fans carving profits out of hot air, market makers quoting spreads in milliseconds and megawatts. If you want to know who runs the show, don't watch the bell. Watch the load curve. Here's the practical coda. For anyone tempted to treat this as spectacle instead of instruction. If you are a builder, build with physics, not against it. Make your models smaller, your data paths shorter, your deployments reversible. Put a price on your dependencies and pay them on purpose. If you are a policymaker, regulate the bottlenecks you already own. Interconnects, water rights, grid queues, before you pretend to control abstractions. Don't auction your future for a ribbon cutting. Auction for resilience and transparency. If you are a citizen, ask who pays when the lights dim. Ask what the reservoir owes the rack. Ask whether a tax break today is a higher rate tomorrow. The trading floor always finds a way to clear. The question is whether you like the price. History keeps whispering the same joke. Every generation thinks its markets are clean. The coffeehouse smelled like smoke. The pit smelled like adrenaline and fear. The data hall smells like nothing at all. But the deals are the same. Proximity, privilege, spreads carved out of distance and doubt. Only the furniture has changed. The poker table is wrapped in sheet metal. The chips are measured in megawatts. The house edge is denominated in egress. And the rule that keeps the game alive is the only one it ever had. No one stands up all at once. So when you hear cloud, translate it into the old language of power. Land, water, wires, heat. When you hear region, hear market. When you hear outage, hear flash crash. When you hear redundant, ask for whom. And when you hear serverless, smile because you know better. There's always a server, there's always a deal, there's always a bill. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.